Bonds and stocks are telling a very different story at the moment. Whereas stocks have recovered very quickly from the shock of the US bank failures, bond markets remain very jittery and seem to be signalling a recession. So in this video, we look at the evidence for and against an economic recovery, and stay tuned to hear what I think is going to happen. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and do like this video. So let's look at the different story from stocks and bonds in a bit more detail. Let's begin with a bull case from stocks. Beside me here you can see various asset classes represented by different exchange traded funds, and the one which has really performed very well over the course of this year is the Nasdaq tracker QQQ. There was a bit of a hiatus when we had those bank failures in the United States, but almost immediately Nasdaq rallied very strongly. For what is a risk rally, it's quite unusual because gold has also rallied, as have long duration US Treasuries. So that's the TLT fund. Now, you might have expected after a bank failure that we could get some kind of credit crisis, but no, junk bonds have also been pretty stable. They haven't rallied a lot, but they certainly haven't fallen a lot either. But certainly for US tech stocks, the case seems to be that everything is now okay. And we also see that if we look at volatility from the options market, which is what the top panel here shows you, the VIX index or the fear index, well, there really isn't much fear at all. When the level of VIX is low, as it is now, that suggests that everything is just fine. People are not buying puts as insurance against stock market falls because they don't see the risk of that fall being material. And in the bottom panel, you can see US high yield spread. That tells you how panicky the credit markets are. And there again, you're not seeing a lot of compensation for the possibility of defaults in the United States. So there's no worry about a credit crisis at all following on from the banking crisis. In fact, what's really remarkable is that there was no spike at all from those very large bank failures, either in stock market volatility or in terms of default risk as perceived by the high yield market. And one major reason why people aren't panicking is that big banks seem to be okay. Well, almost all of the big banks. Of course, Credit Suisse is not okay, but that's going to be merged into UBS, which of course has rallied over the course of this year. Even the worst of the large US banks, Bank of America, is only down 17% year to date. And there you can see that these share prices seem to have stabilized after the shock of those bank defaults. And one reason for that would be the bank term funding program from the Federal Reserve, which is essentially risk laundering using the Fed's balance sheet, where banks can present their not very valuable long-dated treasuries to the Fed and borrow against that as if they were still worth $100. You can see that quantitative tightening has kind of taken a back burner for a while as the Fed's balance sheet soaks up all of those treasuries. And what we can also see is that after the spike of the BTFP usage, it is starting to subside. So certainly for now, the perception is that the Fed's kind of solved the problem and the problems have gone away and stocks can rally again. The Federal Reserve is an important part of the story, of course, because it seems as if the Fed's finally broken something, i.e. the banks. So here are the Fed funds rate increases over the course of the last year, and they did seem to be leveling off, although the Fed was sounding kind of hawkish as inflation looked very sticky. That's why you can see the 2-year rate, which is shown here in blue, starting to increase above the Fed funds rate in anticipation of an even more aggressive policy rate from the Fed. However, those bank failures, again, you can see them as these dashed red lines, almost immediately made the bond market say, no, the Fed's done. It's not going to be hikey anymore. In fact, what we're expecting is the Fed's going to start cutting interest rates from this point onwards. And if we look at the weekly change in that 2-year rate, the single weekly move was absolutely colossal. You'd have to go back 36 years to see a weekly move that was that large and negative. So this wasn't just the market thinking the Fed's going to change direction. This was a 180-degree turnaround in expectations. In fact, the scale of the turnaround was so large that it disrupted the futures markets in rates, which is very unusual. So we got trading halts and a whole group of futures, both in the SOFR market, SOFR, the secured overnight financing rate, 3 of the futures contracts halted trading on 15th of March, and that was due to very large intraday moves. And we also saw the Fed funds futures market, 2 futures, the August and September futures, stop trading as well. So you could paraphrase the thinking from the equity market, which is that the bond market simply freaked out, it panicked, and it panicked too much. And whereas equity managed to absorb this shock without increasing its volatility, the bond market didn't do that at all, and it panicked too much. Usually, of course, it's the other way round. It's the equity market which is panicking. And why are we getting these dislocations in the bond market? Well, one argument is that there's less liquidity in treasury markets. So beside me here, you can see a liquidity index. So a high value here means illiquid markets, and a low value means liquid markets. Notice how in March 2020, that illiquidity measure spiked as treasury markets froze up. But what we've seen gradually over the last year is that illiquidity has returned. That means if there is a sell-off, it causes a very big dislocation in prices. So maybe this is just the bond market panicking too much. And so the bull case continues that if the Fed broke something, then instead of raising rates, it's going to start cutting rates. In other words, the Fed is done. If we compare what the FOMC said at its March meeting this year, and we compare that with what the market's telling us from Fed funds futures, the red dots represent what the Fed funds futures are telling us. That's backed out of market expectations. And the dots above that are what the FOMC, the rate setting committee, each member thinks is going to be the rate at the end of this year. Notice that markets are much more dovish about rates this year than the FOMC. The same is true of next year. The market implied Fed funds rate at the end of 2024 is below even the lowest estimate from the FOMC members. It's only until we get to 2025 when the two tend to agree, because at that point the Fed thinks that inflation will be licked and it can lower rates. So the Fed funds futures market is telling us right now that we're going to get one more rate hike. That's going to be in May. Then at the next meeting, the Fed will hold rates. Then we'll get a cut, hold, cut, 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 cut. So lots of rate cuts coming from the Federal Reserve. In other words, we're at the end of this rate hiking cycle and everything's going to be fine from now on. Inflation must come down, otherwise the Fed wouldn't be cutting. Or at least the Fed's going to give up on its hawkish policy, and that's because it broke banks and it can see that now it should be cutting rates. Now, as you can see in this tweet from Joe Weisenthal, Fed funds futures aren't particularly accurate at predicting what the Fed's going to do. This is called a Medusa chart or a hairy chart alternatively, and the market's just been consistently wrong. At each point in time, you can see its expectations about what the Fed will do in future. When rates were very low for a decade, you can see that they expected the Fed funds futures rate would increase, but it didn't. The market was wrong. And when the Fed finally did start to raise interest rates, they thought it would be more dovish, in other words, raise rates more slowly than it actually did. And if we zoom in on that graph, you can see the current expectations with a very nice little footnote which says, why would the market be right today? So I take these forecasts from the Fed funds futures market with a pinch of salt. They're not necessarily accurate. And that leads us into the bear case. Now, personally, I think there are certain key variables you have to monitor to keep track of what's going on in markets, both in terms of valuation, but also the macroeconomic data. So that's why I've created these trackers for our members to allow you to do that. We've also got some tools for things like savings and retirement. But for example, if we look at stock valuation right now, one of the things we're about to talk about is valuation in the US market. So you can very quickly see where the S&P closed yesterday, but also where that sits relative to certain valuation levels. So as we'll see in a moment, the valuations are not particularly cheap in the US. We're 17% above the 60-year average forward price to earnings multiple, for example, and that's not particularly bullish for the US. So if you do want to learn more about our membership, it's really easy. Just go to our website, PensionCraft.com, to learn more. And there'll be a link in the description beneath me if you want to find the link. Now let's consider the bear case. Although the 2-year yield has certainly moved down very rapidly, it's still the case that the US curve, the yield curve, is very inverted. Short-term interest rates are much higher than long-term interest rates, which is very unusual and usually signals a recession. So in this model from the Cleveland Fed, it turns that yield curve steepness into a probability of a US recession over the next 12 months. And currently that's signaling a probability of more than 60%. It hasn't been that high for a generation. You'd have to go all the way back to 1980 to have a probability which is comparable. Another huge disconnect at the moment is the difference between bond market volatility and stock market volatility. Whereas bond markets are really freaking out with lots of huge price moves, for the stock market it seems as if everything is absolutely fine. So if we look at the difference between two volatility indices, one for the bond market called the MOVE index and one for the stock market, the VIX index, which we saw previously, the difference is the largest it's been since 2008. Now it can't be the case that both of those markets are right. And what usually happens is that if there's volatility in one market, it sloshes over into all the other markets. So I wouldn't be surprised if we did see more equity volatility as a result of the bond market shakeout. Another part of the bear case is that we're simply paying more for lower profits right now. So yes, the US markets have rallied strongly. However, if we look at the fundamentals, which is the profits forecast for the S&P 500, and here beside me you can see that on a quarter-by-quarter basis. So this was the big earnings recession that we got during the pandemic. Then there was a huge bounce back off those very low levels, which gradually faded away. And what we saw for Q4 2022 was a 3.5% fall in year-on-year earnings. But that's not going to be the end of it if you believe market forecasts. So brokers are forecasting that for Q1 of 2023, there's going to be a 6.2% year-on-year fall. And then there'll be yet another year-on-year fall in Q2 of 2023. In other words, there'll be 3 successive quarters where we've got falling US profits. So this rally has not been driven by fundamentals. Far from it. It's been driven by euphoria. And that euphoria has not been grounded in fundamentals of profit growth. So here's how many dollars people are willing to pay for every dollar of earnings generated by the S&P 500. This is a forward earnings multiple. And all that's really happened recently, this tick upwards, is what's generated the rally. Now, euphoria is unreliable. So I think this rally probably doesn't have legs unless we see a turnaround in earnings. And while we saw that the big banks seem to be okay now, the systemically important ones, regional banks are not okay. This is the return over the course of this year for KBW, which is a regional banking ETF for the United States. And what's really notable is that after the huge bank failures, we saw a very sharp fall in this index by over 20%, and there hasn't been any recovery at all. No dead cat bounce. So despite the Bank Term Funding Program, it seems as if equity markets aren't quite so bullish after all. Certainly not for the prospects of the regional banks. And a related worry to do with those regional banks is that they provide a lot of credit for small companies. This is where a lot of the growth in the US comes from, remember, it's small and medium enterprises. And as Jerome Powell said in the March FOMC meeting, this tightening of credit conditions from banks is kind of the same thing that rate hikes do. So just because the market thinks that the Fed's going to step back from rate hikes doesn't mean we're going to get easing credit conditions. Far from it. The reason why the Fed might step back is because banks are doing its work for it. It doesn't have to raise rates if credit conditions are tightening anyway. But either way, that's not good for the stock market. Tightening credit conditions usually lead stocks lower. So we've heard the bull case and the bear case. Who's right? Well, personally, I always focus on fundamentals and I'd look at that profit growth. And that profit growth has simply halted and gone into reverse. For a while, supply chain disruptions meant that companies could keep their margins high. Plus, lots of their consumers still had savings left over from the pandemic. But at a certain point, those savings will be exhausted and the supply chain bottlenecks have now largely dissipated. And that means that profits are also going to suffer, and that support for the equity market has effectively been taken away. And as we saw in those comments from the Fed, we are going to get tightening credit conditions because banks are going to simply be more selective about who they give loans to. and tightening credit conditions, again, are a drag for the stock market. And of course, there'll be a drag for GDP growth. So a recession that follows from that may not be completely off the cards yet. However, we don't see signs of that recession right now. If anything, things seem to be improving, and the path to that soft landing seems more likely. But what we haven't seen is the effect of that banking crisis on credit and tightening credit conditions, which I think actually might tip us into a recession. So personally, I think that the bond market's right here and that we should be more cautious. I think the Nasdaq has got ahead of itself, and I think interpreting what the Fed's going to do as aggressively cutting rates from now on is simply unrealistic. That's not going to happen. So I think it's pretty remarkable that we've had 3 large banking failures in the United States, and yet there's hardly a ripple in the equity markets. If you look at that VIX plot, there isn't much of a tick at all that's visible in terms of rising volatility. The same's true of credit markets. It seems like we're in a state of complacency. So I think there could be better opportunities once markets come round to the way of thinking, which is that everything's not okay after all. But still, for my core portfolio, I'm 100% equity, and if I did do this tactical stuff, it would only be in my fund portfolio. But anyway, if you do want to learn more about our membership, then please do go to our website, PensionCraft.com, to learn more. There'll be a link in the description beneath me. And, as always, thank you for listening.